Fears of higher inflation are driving down investor sentiment across global equity markets today. Stocks in the Asia-Pacific region fell lower as the Dow Jones heads for its fifth straight week of losses. Russia's attack on Ukraine has driven up international prices of oil, natural gas, food grains, and dozens of other commodities. The impact is already being felt, with consumer inflation in the US soaring to a 40-year high of 7.9% in February. Meanwhile, the US, the EU, and other G7 countries are expected to revoke Moscow's trade privileges, a move that analysts say may worsen global supply chain disruptions. Let's now try to understand more with David Madden in London. He's an Equiti Capital market analyst. Thank you for being with us this morning. Now, what is weighing more on markets? I mean, the inflation report was very hot, but somewhat expected. Do you think markets had priced that in already?
I think the main kind of story of the day is sadly the continued violence in Ukraine. You mentioned about the high level of inflation, and I think absolutely the high level was factored in. But realistically speaking, given that a war is going on in Eastern Europe, economic announcements are very much playing second fiddle to what's going on with the conflict. The reality of the situation is inflation has been on an upward run for several months now. Even before we had the Russian invasion of Ukraine, expressions like cost of living crisis was already kind of coming into the kind of was making regular appearances in the media. Inflation was already at a 40-year high in the US prior to the Russian invasion, and even though we've seen a huge move to the upside in the likes of wheat and also energy products such as oil, those uplifts in prices haven't yet trickled down to the actual headline CPI number, which, as you mentioned, came in at 7.9% yesterday. So it'll probably be another 3 to 6 months before we actually see the upward move in commodity prices trickle down into the actual CPI number. So I think everyone is bracing themselves for higher prices, and with that, the Federal Reserve, the US Central Bank have their interest rate decision next week, and it's going to put them in a tricky position. On one hand, you have to tackle high levels of inflation. On the other hand, they don't want to be raising interest rates so much that they actually end up putting the brakes on the economy and risk hiking rates too quickly, and then in turn running the risk of putting the economy into a recession.
Absolutely, the interest rate decision next will be a key focus for markets. But in the meantime, how volatile do you expect energy markets to be, and for how long? What is a price that would balance supply with demand at this point in time for crude oil?
I think in the near term, we're going to see relatively low volatility. And I say relatively low relative to the 14-year high that we saw earlier this week. I think prices, now that we've had the announcement from the US and also from the UK in relation to phasing out Russian oil imports, we may have other countries come into the mix and also impose similar embargoes. But I don't think it's probably going to have the same scale of impact. I also think if we remain at elevated prices in energy for the next few weeks and months, which we probably will, I wouldn't be surprised if we have the likes of President Biden in the US calling on the likes of Saudi Arabia and other members of the Gulf region to actually lift output, just as a way of taking some of the pressure off of the energy price. You mentioned about which level would balance supply and demand. Well, even though we've seen nearly $130 a barrel of oil recently, it is worth remembering we saw north of $140 a barrel in 2008, and we managed to get by then. So economies can cope with high prices of oil, but it does come at a cost. And if energy prices remain elevated for too long, that can chip away at consumer savings. It can chip away at profit margin of business, and that's the sort of thing which can lead to recession in the medium and longer term as well. So it is in the interest in some of the large oil producing nations themselves to actually take some of the heat out of the oil market to essentially prevent a global recession.
Right, possibility of $140 a barrel, very high level. Many thanks for your analysis.